Here is the scary part. If your 2026 income lands just $1, over about $84,600 as a single adult, healthinsurance.org warns you can lose your entire ACA premium tax credit under the returning pre-ARPA rules. That is thousands of dollars of premium help gone over a single dollar of income. Stick with me, because there are legal moves to keep you under that line. I read the fine print so you don't have to. Here is the mechanism. The ACA looks at your household modified adjusted gross income, or MAGI, which starts with your federal AGI and adds back things like tax-exempt interest. Under the old rules returning for 2026, healthinsurance.org explains that once you cross 400% of the federal poverty level, your premium tax credit drops to zero, even if you are only $1 over the line. Getting this wrong is expensive. Premium tax credits can easily be worth between $5,000 and over $10,000 a year for a middle-income household buying ACA coverage, according to healthinsurance.org's modeling. Capstone Wealth Partners shows a family near their cliff where a single $5,000 pre-tax 401k contribution was enough to get MAGI back under the threshold and preserve thousands in premium help. Now the good news, and this is the number to remember, healthinsurance.org calculates that by using above-the-line deductions like an HSA and IRA, a household can trim their MAGI by $27,950 in 2026. That is enough to fall from about $112,000 down to the $84,600 cutoff and keep the credit. Move 1 is the heaviest lever. Max out your pre-tax retirement contributions. Pull last year's tax return, find your current AGI, then estimate this year's income and add planned 401k, CP IRA, or deductible traditional IRA contributions to see how far they pull your AGI down. Healthinsurance.org projects a 2026 traditional IRA limit of $7,500, plus an $1,100 catch-up for age 50 and up, though the IRS must confirm final figures. Move 2 is the HSA plus every other above-the-line deduction you qualify for. Fidelity points to Schedule 1, Part 2 of Form 1040, which lists adjustments to income like HSA contributions, self-employed health insurance, and student loan interest that all lower your MAGI dollar for dollar. Confirm your ACA plan is an HSA-eligible high-deductible plan. Open an HSA and contribute up to the IRS maximum for the year, which is indexed and should be checked for 2026. To make Move 2 concrete, healthinsurance.org projects the 2026 traditional IRA limit at $7,500 base and $8,600 total once you add the $1,100 catch-up for age 50 and older. These are projections, so the ERS final limits must be confirmed for the 2026 tax year before you set your exact contributions. Move 3 is about where your spending money comes from. Capstone Wealth Partners describes an order that protects your MAGI. Draw first from cash and savings with zero impact, then Roth IRA withdrawals, which are generally tax-free and do not count toward MAGI, then sell high-cost basis brokerage assets that carry only a small gain. Only after that do you touch traditional IRA or pension money, where 100% of the withdrawal hits your MAGI. Here is the swing side by side. Do nothing and earn $90,000 of MAGI as a single adult. And healthinsurance.org shows you land over the roughly $84,600 cliff, paying the full unsubsidized premium. Use deductible retirement and HSA contributions to cut MAGI to $82,000. And you stay under 400% FPL and keep the full premium tax credit, saving several $1,000s that year. Before I get to the last part, which is the most counterintuitive piece of all this, here is Move 5. Capstone notes the 400% FPL numbers, like $62,600 for a single adult, and $128,600 for a family of 4 are based on recent tables that HHS updates every year. Re-estimate your MAGI after every planned contribution and withdrawal, and verify your own household threshold for each plan year. If this is useful, subscribe, and the next breakdown is already coming. Here is the counterintuitive finale most people get wrong. There is a myth that if your income estimate ends up too low or too high, you lose eligibility forever or face a clawback that wipes out future subsidies. In reality, ACA guidance shows eligibility is decided each enrollment year on your best estimate. There is no permanent loss, and if you end up in Medicaid or CHIP territory, there is no clawback of the advance premium tax credits you received. The biggest mistake is leaving above-the-line deductions on the table and drawing cash in the wrong order, which keeps MAGI artificially high year after year. Healthinsurance.org and Capstone note that over a 10-year pre-Medicare period, failing to manage MAGI could cost $50,000 to over $100,000 in extra after-tax health insurance spending for a typical 55-year-old couple. Aim to land comfortably under the cliff, not barely under it, so a surprise dividend does not push you over. Let's run the checklist fast. Understand the 400% FPL cliff, max your pre-tax retirement contributions, stack HSA and every Schedule I deduction you qualify for, sequence your spending from cash and Roth before touching income that fully counts, and re-estimate and verify your household numbers every single year. Together, these moves can swing tens of thousands of dollars in your favor before Medicare kicks in. Next, I'm covering exactly how to calculate your own household 400% FPL number step by step, so you know your personal cliff for 2026. If you want to catch that walkthrough, subscribe so you don't miss it. Remember, this is general information only, not personal advice. So confirm current IRS and HHS figures for your plan year before you act.